Hello, my name is Joe HOYLE, speaking to you from the University of Richmond. Today we're going to talk about Chapter 7 of your financial accounting textbook. When you get ready to read this chapter, what are you going to see? Well, you're going to find that Chapter 7 is quite different than the first 6 chapters. In these earlier 6 chapters, we worked to introduce you to financial accounting. We talked about things in general. Generally accepted accounting principles, financial statements, double entry bookkeeping, the accounting profession, but so far we have really not looked at any account in detail. That all changes in Chapter 7. For most of the rest of the book, we will look at individual balances and help you to understand what they mean, so that when you pick up a set of financial statements and you look at what they're reporting, you will understand what that means. We begin with accounts receivable. If you look at a balance sheet and you find accounts receivable and it has a balance of $1 million, what exactly does that mean? We talk about accounting being the conveyance of information. So anytime you look at a balance, that should be your question. What information is being conveyed by this account and by this number? What does the number $1 million represent if you're talking about accounts receivable? For accounts receivable, you report net realizable value. Net realizable value is simply an estimation of the cash that you can collect from that asset. So if you have $1 million reported for accounts receivable, that's the amount of cash that you anticipate collecting. That's interesting information. How exactly is that reported on a balance sheet? Well, you begin with the total figure that is due to you. For example, a company might have accounts receivable of $1,040,000. You then subtract out your estimation of the amount of those receivables that will never be collected. That subtraction is called an allowance for doubtful accounts. So you might estimate here that $40,000 of your accounts receivable will prove to be uncollectible. Accounts receivable was $1,040,000. The allowance for doubtful accounts, the ones that you don't think will be collected, is $40,000, and that leaves you with $1 million to report the net realizable value. Now that we know what is being reported on the balance sheet, the question has to come up, when do we make these estimations? When do we recognize these accounts that are not going to be collected? Well, keep in mind that the timing of recognition is guided by accrual accounting. And one half of accrual accounting is referred to as the matching principle. We covered this in earlier chapters. So if you make a sale in year 1 and you think that some of those accounts will prove to be bad in year 2, do you recognize the expense in year 1 or year 2? The matching principle would say that you recognize that in year 1. The revenue is recognized in year 1. Therefore, the bad debts should also be recognized in year 1. That's consistent with the application of the matching principle. How do we determine this estimation? Obviously, you don't make sales when you think they won't be collected, but you do realize that some will prove to be uncollectible. How is that estimation made? Well, typically estimations are made first by looking at the past history. Look to see how many of the receivables in the past have proven to be uncollectible. Typically in any estimation, you begin by thinking about what is shown in the past. Then, of course, you should think about whether anything in the current time would change that past experience. For example, in good economic times, people tend to have money, and therefore you probably have less bad debt expense. In bad economic times, when money is tight and people cannot afford to pay as quickly, you often have larger bad debts. So it is the past information, but it is modified for any current data that comes up. But now that's a general idea for any estimation. How do you estimate uncollectible accounts? We really have two different ways to make this estimation. A lot of companies do it through what is called the percentage of sales method. They take the sales figure that they have for the period and they multiply that times the percentage that they expect to be uncollectible, the percentage of sales. Other companies use what's called the percentage of receivables method. They take total receivables and again multiply it times the percentage that they believe will prove to be uncollectible. One variation of the percentage of receivables method is called the aging method, where you use a different percentage depending upon the age of the receivable balance. Once you have that, once you have made your estimation, once you get ready to record it in the year of sale, how do you actually do that? This is a point that students often find a little bit confusing, so let's be careful here. If you've used the percentage of sales method and you've come up with an estimation, that figure is added to both the bad debt expense that's reported on the income statement and the allowance for doubtful accounts that's reported on the balance sheet. In my classes, I call that the add-in method, because once you've made your estimation, you simply add that figure in to both the expense and the allowance for doubtful accounts. In contrast, if you use the percentage of receivables method, you do it a little differently. Once you make your estimation, you bring the allowance for doubtful accounts up to that balance. In my classes, I often call that the up to method. The allowance for doubtful accounts will frequently have a residual figure left in it from the previous year. That residual figure is brought up to the estimation. So in percentage of sales, if you estimate 10,000, you add in 10,000 to the expense and the allowance. In the percentage of receivables method, if you estimate 10,000, you put in the figure that brings the allowance for doubtful accounts up to $10,000. A very important little distinction for you to notice. There's one more thing that you need to know about reporting accounts receivable and bad debts. Eventually, some customer will prove to be uncollectible. That customer will die or leave town or go bankrupt, and the balance will prove to be uncollectible. What do you do at that time? Whenever you discover that an account is uncollectible, you reduce the account receivable balance by that amount and you reduce the allowance for doubtful accounts. That's all you do. Notice you do not recognize a bad debt expense. The reason is that you've already estimated that amount and recognized it previously. So if you have an account that is uncollectible, then reduce receivables and reduce the allowance account, but do not recognize an expense. It's very easy to think, oh, I have a bad account, it's an expense. No, you've already estimated that amount and you've already recognized it in the year of the sale. Don't recognize it again. In these days, companies often make sales in foreign countries. And when they do that, sometimes they get a contract to receive a foreign currency. You might make a sale in Japan, for example, and agree to take the Japanese yen as the amount that you receive. Now that's not stated in US dollars. How do you report a foreign currency balance that's stated in some other denomination? United States generally accepted accounting principles say that monetary assets and monetary liabilities, And for our coverage in this introductory class, that would be cash, receivables, and payables. Those balances should be reported at the current exchange rate. So if, for example, you make a sale in August, and in December you're reporting the receivable, then you should use the currency exchange rate in December. That's the cash, the receivables, and the payables. They are updated every time the exchange rate changes, and that updating creates gains and losses on the income statement. All other accounts, inventory, prepaid rent, rent expense, sales, all other accounts, when you report those foreign currency balances, you use the old exchange rate that was applicable on the day of the transaction. You do not update those. Now, 40 or 50 years ago, this was unimportant because most companies did not deal in exchanges in foreign countries. But today, most companies do. I want you to understand how that reporting process is handled. Cash, receivables, and payables are updated for new exchange rates. All other accounts are not. And finally, we introduced the idea in this chapter of vital signs. These are things that decision makers look at to help them determine the financial health, the future prospects of an organization. It really isn't accounting as much as it is the use of accounting information. One that I want to draw your attention to is the age of receivables. How old are your accounts receivable? Companies do not like for their receivables to get too old. It makes them more likely to be uncollectible, and it simply means that you don't have the money to use. Therefore, companies will often determine the age of their receivables every day and make sure that they're not getting too old. How do you determine the age of receivables? Take the sales per day and divide that into the account receivable balance. The amount of your sales on an average day divided into your account receivable. That gives you the age of the balance. Now, there's a lot in Chapter 7, but it all deals with accounts receivable. We are now going to start looking at individual accounts to make sure that you understand the information being conveyed. Accounting conveys information for decision making. Therefore, what do these balances mean? What information is being conveyed? Read Chapter 7, you'll learn a lot.